Good morning. You're watching Business World Live. I'm Danie, Laurel.
And I'm Jess Delos Santos. It's the start of a new trading day, but first, let's go straight to our top story. FDI net inflows hit a 7-month high in July on the back of improving sentiment following the economy's gradual reopening. Net inflows jumped 35% to $797 million from $590 million in July 2019, that's according to the Banco Central. This was also higher than the $481 million inflows in June this year and the highest since December 2019's $1.15 billion. However, net inflows for the 7 months to July declined 11% to nearly $3.8 billion from the same period last year. The Banco Central says inflows were channeled largely to the construction, real estate, wholesale, and retail and manufacturing industries. Union Bank Chief Economist Carlos Asuncion says a recovery in FDI remains uncertain as sentiment remains clouded by the health crisis and the lack of a vaccine. Asuncion says that if a vaccine comes in the part of 2021, FDI may rebound faster than expected. All right, let's have a quick check now of what's happening in the markets. But first, let's go to our local currency. Dan, the peso has been leading the pack these past months, but recently has been facing headwinds. Is there room to go for the local unit?
Well, that's a very good question, Jess, especially if you can see on my terminal here, the Philippine peso has now slid to second place, but that's still not a bad showing, So Taiwanese dollar now stronger than us. We used to be the strongest currency just a couple of weeks ago, not just in Asia, but all across developing markets. But nevertheless, not a bad showing. We're actually one of the strongest we've seen in 4 years. We can see our spot returns for the year to date. That's at 4.34%. So if you had invested in the peso, you would have gained 4% pa, which is significantly higher than the more than 25% drop that we've seen in equities markets, for example. Now, let's take a quick peek at how we are performing this morning in particular. You did mention the exact same sentiment. The peso actually weakened as there was all these debates on what's going to be happening in the speakership. That seems to have been, so to speak, resolved yesterday, but nevertheless it was weakening as the market is still awaiting the 2021 budget approval and amid all of these continuing deliberations over in the Congress. So another trader had also said that the peso weakened. That's after President Donald Trump announced that he wants a bigger stimulus over in the U.S. So on Friday, President Trump actually offered a $1.8 trillion relief package, and this comes days after he called off those negotiations. So that seems to be strengthening the dollar and as a result, weakening our own local unit. Now, let's take a step back and take a look at how Wall Street had performed overnight. I mean, a big standout here, that is the NASDAQ. That's up by 2.6%. That's the best day of trading for that index. It's since the month of April. That's of course as mega cap tech stocks rallied. So that posted its biggest advance. That was up by as much as 4.1% yesterday. And of course, this amid the US starting to have the third quarter earnings come in, and that's going to be something that investors are watching. Amazon is also gearing for its Prime Day bonanza. Apple will have an event where it's expected to unveil 5G. So a lot of exciting things going on over in the tech space. Now, when you take a look at China, there's also a very interesting thing to be watching out for. In fact, the China Central Bank said it will be lowering the reserve requirement ratio for financial institutions when they conduct some foreign exchange forwards trading to zero with effect from Monday. So right now, the financial institutions over in China, they need to set aside 20% of the previous month's yuan forwards as, let's say, a reserve for foreign exchange risk. They no longer need to keep that. They can now keep zero. So basically, they will have all of this liquidity when it comes to forex reserves released. Now, China, however, this according to the central bank governor of China, Yi Gang, will be maintaining a normal monetary policy for as long as possible. In fact, they said that excessive stimulus could lead to debt expansion and create asset bubbles that will increase long-term systemic risk. So very, very careful when it comes to their monetary policy there. Now, this seems to be what has moved our own local boards yesterday. That's according to Darren Pangan of Timson Securities, precisely because of the stimulus that might be going on over in China. And in fact, we were up a touch. That was up by 0.09% yesterday. It seems to be, let's just take a peek at the index opening now. It's 6 minutes into the trading day. We are down a touch. So we are at 5934.07, down by 0.14% in the past 3 days. Now, another thing that Luis Limlingan is saying is that it did help that the fiscal stimulus of Donald Trump actually did help the bourse yesterday, but again those budget talks seem to be what is stalling the local index from another rally. So value turnover was a little bit weaker than usual. That was at 5.34 billion pesos. Meanwhile, foreign investors recording their 22nd straight day of net foreign selling. We lost around 437 million pesos from our foreigners just on Monday. Now, taking a step back and seeing which of these sectors are actually dragging us down, if anything, or whether they're bringing us up. It seems to be services, the only bright spot today. That's up by 0.7%. Meanwhile, properties seem to be significantly sold off at the open. That's down by 0.7%. Financials as well bearing the brunt. Now, let's talk about financials. There's some new reports coming out here, particularly from our two debt watchers. So basically checking in on the health of our own lenders and banks. So let's take a quick peek. BPI and Security Bank, okay, the ratings outlook were revised to negative from stable. That's from Standard and Poor's. So again, BPI and Security Bank now negative outlook. S&P has cited higher than expected risks that the credit losses will be soaring because of course, the challenging economic conditions. Nevertheless, their credit ratings were still affirmed. So that's still at BBB plus for BPI and BBB minus for Security Bank. They're saying that the recession is likely to impair the debt servicing ability of the consumers, small businesses, and leveraged companies. They said there's 1 in 3 chances of economic risks facing the banks could increase in the next 6 to 24 months. But nevertheless, you can see Security Bank still actually posting some gains this morning. That's up by 0.6%. BPI, meanwhile, is down by 0.9%, Jess.
Okay, now moving over from the financial sector, let's move into some other heavyweights here, particularly one conglomerate here. I mean, so much talk after that 2021 budget really still hanging in the balance here. At least the private sector is set to move forward in pulling its weight in the infrastructure space, and I can almost imagine myself flying out of that Bulacan airport.
I know. So can you believe it? We were talking about travel just before broadcast and how everyone just dying to get out of there. But that might be closer and closer to reality here. That's as San Miguel got the okay from the Senate on its airport franchise. So just to recall, this has been something that we've been talking about for quite a while. This is a measure granting a 50-year franchise to this biggest conglomerate in the country, basically, to construct and operate not just the airport, but also the airport city, okay? So that has been approved already by the Congress, but now finally on third and final reading from the Senate. And get this, 22 affirmative votes and 0 negative. And this has been a topic of contention, especially from the Department of Finance, because they want, revenues from that. They were also worried that granting too much incentives would cause all the other bidders to start asking for incentives, diba? And mawawalan din ng tax perks.
In future projects, yes.
Exactly. But nevertheless, this according to Senator Grace Po Yamanzares, who did vote for, up to approve this franchise. She said that the San Miguel Airport alone will provide 450,000 jobs during this construction phase. And then after that, more than 1 million people will be able to benefit, plus not to mention the hundreds of thousands of passengers that will be flying in and out of the country every day. We do need that tourism. So that's what she's saying is, leading her to vote for this San Miguel. Above 100 pesos now, trading at 6.10, up 0.6%. And another thing to be watching out for are, of course, the airlines that will be using that airport. I just want to take a quick peek at how our airlines have been doing. Those have been arguably the worst stocks of the pandemic, and maybe some reprieve for them. This is AAP, that's the Civil Aviation Authority of the Philippines, they will be waiving airport fees for these domestic airlines. Okay, so that's of course under the Bayanihan to Recover as One Act, which expires on December 19, 2020, but they're trying to maybe see whether they can extend that. So the intention is basically to waive all of the landing and takeoff fees as well as the parking fees, which is one of the initial assistance from the government towards this ailing airline. So CAAP earlier said airlines actually pay around 500 million pesos per month for such fees. Now, just taking a quick peek, Cebu Pacific, however, down by 1.6% this morning, PAL trading unchanged. Now, Jess, moving on, you've also got a lot on your plate here, figures of your own. Let's move on from airlines over to cars. Now, car sales plunging in the first 9 months of the year, but how bad was this plunge?
All right, we're talking about a 45% dive, at least in the first 9 months of the year. These, of course, are figures coming from CAMPI, or the Chamber of Automotive Manufacturers of the Philippines, as well as the TMA, or the Truck Manufacturers Association. So if we try to take a look at the figures here, 9 months to 2020, they were only able to sell 148,000 units. That compares to the 267,000 that were sold in the first 9 months of 2019. Now, at the same time, we try to divide it by segment. You would see here that passenger vehicles actually dropped by as much as 45%, which is 44,000 units sold. At the same time, on the other hand, you have commercial vehicles plunging by 44% to just 104,000 units. Now, also, a look at September figures would show that there was a drop of as much as 23% in combined sales of both passenger cars and commercial vehicles. Passenger cars, for one, were down by 12%. And get this, commercial vehicles even sliding by as much as 28% to just 16,000 units sold in the first, at least in the month of September for 2020. But here's one thing that car manufacturers and distributors are actually banking on. Yeah, month on month, September sales were actually up by as much as 37%, with passenger vehicle sales rising, get this, to even as high as 57%, and commercial vehicles not so far behind, up by 28%. And this is really what's driving some level of optimism here for CAMPI. They are saying that they are seeing recovery in car sales by year end. That at least is according to their president, Romel Gutierrez. Is saying they are remaining optimistic, but at the same time, they are also still cautious as consumer spending is still below pre-pandemic levels due to evident shifts to essential goods and services.
Super interesting, Jess. So some, light at the end of the tunnel, so to speak. Now, while we're at it, you've got, of course, GT Capital, which is our listed conglomerate, which does own Toyota, which has the biggest market share in terms of passenger vehicles. They have now received the go signal from the Competition Commission to acquire Toyota Santa Rosa. So what's the story here? Didn't they already own this, or how does this add to the pie?
Okay, so this time around, you have a GT Capital Auto Dealership, or GT CAD, getting at least the nod from the Philippine Competition Commission to fully purchase Toyota Santa Rosa from TMCP. And just to give you an idea, Toyota Motors Corporation is 51% owned by GT Cap as it is. So in this new deal, it would show that 60% of Toyota Santa Rosa will be actually going to GT CAD, and then the other 40% will be going to Toyota Corolla Sapporo, which is a sister company, of course, of GT CAD. Let's see how this will actually help bump up the Toyota Group's performance. Recall that in the first half, income was actually down by as much as 77% to just 994 million pesos. That's due to lower sales of assembled and imported auto parts and spare parts. In fact, GT Cap as well, their income was down by as much as 62% to just 2.74 billion pesos. So let's see how things will be faring for the stock as we move along in the trading day now.
And just to mention, GT Cap is actually in the green this morning. That's up by 0.7% to 390 pesos. But Jess, this stock has been heavily sold off. It's down by close to 60% year to date. Okay, guys, moving on to the biggest headlines we are watching this Tuesday morning. Let me just scroll through that. There's a lot to be digesting this morning. All right. The Philippine Star reports that infrastructure spending declined 11.5% from the month of January to August. The budget department attributed this to delays in construction activities, which were caused by lockdown restrictions and the rainy season. DBM data shows that infrastructure and other capital outlays dropped to 394.5 billion pesos in the first 8 months. That's from last year's 445 billion pesos. Now, aside from lockdown restrictions, the agency also attributed the lower spending to higher base effects with the settlement of accounts payables last year. The DBM expects infrastructure and other capital outlays to remain muted for the rest of the year. That's as some projects can no longer be implemented nor completed due to the pandemic. Now, instead, government spending for the last months of 2020 is seen to be driven by maintenance expenditures, specifically for health and social related expenses, with the passage of the Bayanihan 2 law. Now, the slump in remittances may continue until next year. That's as more OFWs are expected to lose their jobs. IHS Market Chief Economist for Asia Pacific, Rajiv Biswas, noted that remittances will remain lower than pre-pandemic levels, with over 100,000 OFWs forced to return home due to the pandemic. More are expected to follow. Remittances rose 7.8% to $2.7 billion in July, which is the highest in 7 months. However, its year-to-date figure declined by 3.4% to nearly $17 billion. The IMF said the uptick in July may be due to OFWs tapping into their savings to send money back home. ING's Nikki Mapa also expects a contraction in remittances this year and next year, with the number of migrant workers likely depleted. Mapa said a 10% drop in remittances this year and a flat growth for 2021 are likely. These scenarios, however, could complicate recovery, he said, with the country losing a steady and reliable stream of foreign exchange.
The Labor Department, meanwhile, will be meeting with employers and workers groups to discuss the possibility of deferring the 13th month pay for this year as COVID-19 continues to impact businesses. Labor Undersecretary Benjo Benavides says that the consultation is meant to come up with a solution that will be mutually beneficial to both sides. DOLE is set to meet with sector representatives today to discuss a possible deferment of the 13th month pay and the extension of period that allows workers to be classified as temporarily displaced. Benavides says that while there is no provision in the law that allows a deferment of the 13th month benefit, its implementing rules indicate that distressed employers can be exempted from making the payment altogether. Businesses that may apply for distress authorization are those that have been incurring substantial losses, and for the case of nonprofit organizations, has had a decline in income by more than 40% of their normal income for the last 2 years. Benavides says that in the last few years, no company has applied to DOLE for such exemption. With the future of schooling hanging in the balance and students encouraged to study remotely, how do you convince people to keep investing in educated-related real estate? Here to share with us their plans, we have with us Torre Lorenzo Development Corporation's President and CEO Tomas Lorenzo. Good morning, sir. Great to have you here with us on the show.
Good morning, Jess. Good morning, Danie.
All right, sir. Obvious first question here. How are you guys doing amid this pandemic? Of course, we're talking about TLDC here. You have a niche market to cater mostly to students, especially in key university areas here. Has that affected the take-up of units here, especially when it comes to leasing? Are we seeing a rise in vacancy rates here the past academic year?
Well, that's a good question, Jess. I guess for our projects, since our residents stay anywhere from 3 to 4 years, they're just looking at this as a temporary situation. So our leasing units are still pretty good. There are also students who have gone home, but they've kept their units because I think by next semester there will have to be some sort of hybrid education, especially for those who need laboratory or in classroom activities. And we've also been able to manage our buildings with this new normal. We've really improved on all our safety protocols, distancing, wearing of masks, delivery of food. All of that has been managed so that when, especially the parents, when they see their children having to go back to school, they will choose the safest building near the school possible.
All right, sir, just to follow up on that question here. But definitely, did you see at least demand dampening for your spaces here? And when do you see things picking up in the near future? Like what you mentioned, at some point there has to be a hybrid setup here for schools. When do you see that happening?
Well, okay. So in our business, we have residential units which we sell to parents and to investors, and these parents more or less buy the unit 2 to 3 years before they need the units. So the demand the interest is still there, but I guess the parents are taking on a wait and see attitude to see when things will ease up. But they are definitely still talking to us, and we are still able to sell units to these parents. Now, for those who are leasing in our buildings, they are also waiting for the school authorities to tell them when they have to go back. What's interesting is that a lot of them, even if they have internet at home, they would like to be near the school still in case something goes wrong with the internet wherever they are. We also have students from faraway provinces, southern Mindanao, Ilocos, and the like, where it's not an option for them to live nearby. They have to live in a condominium near the school. So what we try to do is we provide the best living experience even under this pandemic.
Sir, tell us how you've marketed this situation now. Have you made, payment terms more flexible, shifted to digital? Some have been doing that. Have you seen a significant increase in tapping of loans, for example? So the BSP has now actually allowed an increase of the cap to the real estate sector. The interest rates are generally low. And as you mentioned, residential is still something that's been growing. So there's a recent BSP report that it's actually surpassed their expectations. How are you managing this liquidity that's in the market and getting people to still invest amid this uncertainty?
That's a good question, Danie. Well, I'm really thankful that the BSP has been supportive and extended real estate loan exposure for banks from 20 to 25%. Our buyers, they are still, our payment terms are very affordable. So, and they normally pay this over the construction period, over a period of time. So it is affordable to our buyers. And so I really look at this pandemic as more of a pause rather than a full stop. So even in terms of our pricing, we've made it very, very affordable to those who are interested. Like I said earlier, many of even our foreign buyers, Filipinos who are living abroad, they see our product as something very long term. They take a minimum 2-3 year horizon, which is about what everyone is talking about, and schools will have to at least some schools will really have to do a hybrid sooner more than later because how can you take engineering? How can you take medicine online?
Yeah.
So
Medyo mahirap, sir. So
yeah.
less discretionary type of properties actually, in this case when you're talking about education.
Yes. In fact, you always look at our product as not part of the housing budget of the Filipino, but rather part of the educational budget
Education
of the
budget.
Filipino.
Now,
Um, yes.
sir, one thing I want to drive on here is that are you casting a wider net here in areas outside the metro? I mean, from home setups have been the theme since the start of the pandemic here, and you hear a lot of some of developers actually saying that they are now shifting their preference to areas outside the metro. Is this something that you are transitioning to as well, and not just in the residential property, residential spaces, but even non-residential like your hotels?
Yes. We saw that opportunity early on, about maybe 7 years ago, because we saw that the Metro Manila market, although very healthy and robust, there's really a move to the provinces. So we started looking at growth areas. And so now we have projects as far north as Pampanga and as far south as Davao. Of course, these are not university residence projects. They're actually condominium projects for people who would like to move to a condominium. It's a novel concept for many. For example, we have a Lipa, Torre Lorenzo, Lipa, Batangas project, and it's novel for people to live in a condominium. But we saw that opportunity, and we've been really looking at the provinces. For Davao, we looked at really not just a condominium complex, but more of a mixed use township project. So our projects outside of Metro Manila usually include hotels and condominiums and commercial and office spaces.
Sir, just to press on that, how has the pandemic changed your strategy? It was always primarily, turnover units for the education sector. And you did mention you were starting to get into hospitality, you were starting to get into condominiums, recurring revenues. Has anything changed? Are you going to be focusing more on specific areas? Are you looking at turnovers versus recurring revenues right now?
Well, Danie, it's interesting that even with this pandemic, for example, our hotel projects in Davao, they they never really closed. We were allowed to remain open, of course, with all the protocols required by the LGU, by the local government. And there is still a demand. And again, as soon as this pandemic is over, or people start to see the light or get closer to the light at the end of the tunnel, I really see a big tourism boom. Of course, with all the protocols in place, which Secretary Berna Romulo Puyat is spearheading, no. And we see it in other countries. We see other countries where the local population are taking up the slack of foreign visitors. And then also since our projects outside are mixed use townships, it's really the leisure portion is just one component of the whole lifestyle which we're trying to give to that area. So we have so many other things there. We want to be able to offer a live, work, play setup lifestyle for our buyers and for the visitors to that area.
All right, so definitely the leisure segment, something that property developers are banking on as well, especially as we expect the tourism sector to recover in the near future once the pandemic is over. Thank you very much, Torre Lorenzo Development Corporation's President and CEO, Tomas Lorenzo, for spending your time with us this morning, sir.
Thank
Thank you,
you.
sir.
And that's a first look into the business day this Tuesday. I'm Jess De Los Santos.
Catch us again tomorrow morning, 9:30 a.m. I'm Danie Laurel. We are One News.